This week, it's time for Security Money. While the major indexes have improved, the Security Weekly 25 index has not. What's next for the market? In the leadership and communications section, who does your CISO report to? 5 CISO traps to avoid and truths to embrace. How to effectively communicate cybersecurity best practices to staff, and more. Business Security Weekly starts now.
This is Security Weekly, for security professionals, by security professionals. Broadcasting live from G-Unit Studios in Rhode Island, it's the show where we explore the business of security to improve the security of business. Your trusted source for actionable insights on leadership, communication, and innovation. Get ready for Business Security Weekly.
According to the 2022 Data Breach Investigations Report, 82% of breaches involve the human element. Yet most security awareness and training programs focus on compliance requirements, not the risk humans pose to your organization. Living Security is the leader in human risk management. This new approach transforms human risk into proactive defense by quantifying human risk. By understanding your riskiest and most vigilant users and activities, you can engage these segments of your workforce with relevant training, communications, and policies to truly change their behaviors. If your goal is to finally change your workforce's behavior, visit securityweekly.com/living security to learn more today. Mimecast has released its State of Ransomware Readiness Report for 2022, finding that most cybersecurity leaders experience the same or increasing numbers of ransomware attacks over last year. Together with Mimecast, organizations can stand strong in the face of cyber attacks, human error, technical failure, and work protected. Mimecast, work protected. Visit securityweekly.com/Mimecast to learn more.
Welcome to Business Security Weekly. This is episode number 293, recorded February 6, 2023. I am your host, Matt Alderman. Joining are my co-hosts remotely. First, welcome back, Mr. Jason Albuquerque.
Matt, great to be back. I missed you guys last week. Unfortunately, a little under the weather. But not much football to talk about. I mean, they had the Pro Bowl, but now it's flag football. Kind of interesting.
I just wonder how many people actually watch, because I had no interest in watching pros play flag football.
Yeah, it was. I didn't. I won't lie. I did spend some time watching the Pro Bowl games. It was interesting. I don't know if I'll watch next year. How about that?
Yeah, there you go. NFL, we'll see what you do next year.
Right.
Also joining from Idaho, Mr. Tyler Robinson. Welcome, Tyler.
Thanks, Matt. Good to have you back, Jason. And flag football with professionals. That sounds horrible. That sounds like
it does.
The worst idea ever.
Yeah, too bad.
No. I mean, at least like the NBA All-Star game, you have a bunch of different things, right? You got the slam dunk contest, all the other stuff. Mm-hmm. I just don't see the flag football thing being a big
should do like
draw.
Longest throw, a couple guys all trying to receive or intercept it, longest kick. You could do some fun stuff.
Yeah. Longest kick.
I mean, they did have some skills there in between the 3 flag football games.
It's flag football. Like, this sounds weird.
I feel you. I had to watch the circus. It's all good.
All right. The housewives come
out. Yeah. I'm glad you did it. I didn't go through it. Do you have a specific guest or topic that you want us to cover on one of the shows? Submit your suggestions for guests by visiting securityweekly.com/guests and completing the form. We review suggestions often and we'll reach out to you once reviewed. All right. So last time we did Security Money was October 17th. And I asked to push this back a little bit. So it's the second month of the quarter, the first kind of segment of the month, because I wanted a little more time to gather all the news and all the information. And it got interesting because the timing for this segment correlates to a couple things that have happened over the last week that are just, they're a little almost shocking, right? When you think about the market for instance. So let's start with that first, because I think it's really interesting. So the first bit of news that comes out is IronNet gets basically a delisting notification from the index, from NASDAQ, right? Mm-hmm. Because they've cratered so much in their stock price and their market cap, they're basically like getting ready to be delisted as a public company in the cybersecurity space. And then right behind that, like 2 days later, 2 or 3 days later, Siren basically lays off their entire staff except for a couple executives and are looking to sell the company. Public company number 2 in like a really bad bind. And you're sitting back going, whoa, like that happened pretty fast.
Yeah. And Matt, I don't know if you know, but for the New York Stock Exchange, what are the listing standards? I think you have to like maintain the price of $1. It's like, it's not this super high bar, but I mean,
yeah,
obviously they're in a bad way.
Yeah, there's actually a news article. IronNet announces receipt of continuing listed standard notice from the New York Stock Exchange. And yeah, it has to be at least $1 per share over a consecutive 30-day trading period.
Right.
Yeah.
And
they can't even meet that.
Were they really that overvalued and crashing at the same time? I know we got like recession happening, but there's a couple things going on there.
Yeah, but remember how IronNet went public? They went via a SPAC. They did not do a traditional IPO. They and ZeroFox went through a SPAC to go public. Okay. Now, ZeroFox is the only company in the security space that went public last year via the SPAC vehicle. And I've talked to Foster, the CEO, and they seem to be doing pretty well. IronNet went through earlier in a very similar vehicle. So the question becomes, when you come out via a SPAC, did it generate enough kind of infusion into the company to be able to take that money and use it wisely and grow the company, where other IPOs, take some money in by selling off a portion of its public stock, then they use that to operate the business and grow the business. It was the kind of the traditional way. So I think part of this boils down to how IronNet went public in the first place. And then Siren is, very, very interesting. Okay. So let's get into the index itself. So a few changes on the index. And some of these we kind of knew were coming, right? Ping had been acquired in Q3 by Thoma Bravo. And so I knew I was going to have to replace them. The replacement didn't happen until October 18th when Ping stopped trading on the market. So I had to find a replacement for them. I put A10 networks into the index and refactored the entire index as of October 18th. Mm-hmm. My challenge going forward is I don't know who to put in next because KnowBe4 is going to come out. KnowBe4 stopped trading on Friday because they finished the acquisition with Vista Equity. So KnowBe4 is going to come out of the index next quarter. And outside of A10, which I just pulled in, I don't know who's next on the list to pull into the index.
And I found A10 interesting because their last 3 months has been a 12% decline, right? Mm-hmm. Now, I know from their numbers, they're looking at a net positive return on equity. I think it's like 25% for them. But at the end of the day, their last 3 months was 12% decline.
Yeah.
So, yeah, I mean, I think we're going to start realizing some of the barriers to looking at pure play at this point because of all the consolidation happening, right?
Yeah,
and KnowBe4 was a big play too because they were 4.6 billion acquisition. They were like 400 million in raised, so that's a large number to have to kind of reconcede, especially in today's market.
Well, and remember they came out in January of 22 and were bought roughly 10 months later. So they went IPO and then they get a buyout on the private equity side. Yeah. The other change to the index, which doesn't really affect the index, is Norton LifeLock changed its stock symbol to GEN. So when Norton LifeLock and Avast merged officially, they changed their name to Gen Digital and changed their stock symbol to GEN. That happened on November 8th. So all the NLOC previous polls still work correctly. Thank goodness I didn't have to refactor all that into the equation. But just another interesting kind of change in the index. They changed their name in their stock symbol.
Yeah, I mean, all of that consolidation now they have to remarket, rebrand, right?
Yep.
I mean, because it's a lot more than that too, right? It's Norton, Avast, LifeLock. I think they have AVG. some of the consumer stuff like CC Cleaner, like that type of stuff. So
Yep.
yeah, there's a bunch of different product lines in there.
Yeah, a lot of stuff embedded. So at the close on Friday, the index was sitting at 1237.76. So it's still up from when I started the index, which was baselined at 1,000. So it's up 23.78%, but it's down from last quarter since we started tracking this. The NASDAQ ended at 12,006 and 96 cents, which is an increase of 80.96% from the same time period. So, and it's up from last quarter. So what you're seeing right now in the market is this really interesting divergence. The index and the NASDAQ have tracked each other almost identically over the last 4.5 years I've been pulling this data. This last round, we're seeing them diverge. We're seeing the NASDAQ increase at a much higher rate, and the index is lagging behind. And Jason, I think this comes in a little bit to, this pure play concept.
Yeah.
Is, can this industry stand on its own as a set of standalone products, or does it need to be part of a bigger portfolio, because those bigger portfolios from a technology perspective appear to be performing better?
Right. And I think we're going to have to really take a hard look at it, because the non-pure play who are acquiring all these cybersecurity companies and products, and they're taking out the likes of the Siren, right? I mean, that's part of the reason that some of these companies are folding and going under and laying off, because now you have these behemoth organizations, Microsoft, who can do all of the between all of the feature functionality and service that these organizations are bringing to the table. You have these behemoth companies now just either chewing you up or leaving you to die.
Yeah.
There's
exactly
definitely
right.
there's definitely very few pure plays, I think, and that's been kind of the whole market trend. Is if you're doing something well and you have some value, you're going to get acquired. I mean, with the Auth0, you got Okada doing a bunch of stuff. The pure play stuff is getting very difficult. And I think even as a small company, if you're looking to go startup and you're trying to make those plays to remain in the market, if you're not looking for that initial sellout, it's going to be very difficult to do so because of the competition and what the dollar amount these larger companies are bringing into the market for those particular verticals that they're in with the smaller companies they're acquiring.
And the game is changing. I mean, let's harken back to our nice conversation with Mr. Herjavec, right?
Yeah.
Mm-hmm. Now you need to start showing EBITDA and profitability and cash flow. Like the rules changed, right? They got a lot tougher. So it's a lot tougher to succeed now.
You have to do a lot more with less money.
Mm-hmm.
Right. And they changed almost overnight. Now, remember, when I did these results and when we look at performance and some of the other things, that was done for Q4 based on Q3 results. What'll be interesting next quarter when we look back, which is presenting Q4 results, and then eventually Q1. So I'm a quarter behind because of the reporting requirements, but I expect to see some more losses starting to show up in some of these public companies, Jason, to your point, because overnight the stuff changed, right? The rules changed overnight, and we haven't seen in the financial announcements in all of their reporting reviews the full impact of what happened in between Q3 and Q4.
Yeah, I mean, the majority of these companies have just closed their books. They just closed out their year, right?
Yeah.
So it'll be very interesting to see, next conversation we have, how last year closed out.
Yeah.
So what do you think some of the new verticals, like we already have seen identity kind of pick up, right? Like from a pure play, that's going to be very difficult in identity. I think the next kind of horizon outside of identity, we've just started to see the uptick is artificial intelligence, right? We've seen a lot of companies use that or call the ML play, but pure AI from a cybersecurity standpoint, I think is going to be a play that many companies are either looking at or beginning to make that venture and then integrating that into their solution from either an offensive or in a defensive position.
Yeah. And I mean, the big dogs are already eyeballing that as well. I mean, Microsoft's, partnership with OpenAI and ChatGPT. I mean, Google has been doing this forever. They've just been under the radar. That's all.
Right.
So the big dog's already there, which is to the conversation. It's going to be hard to find the pure plays. It's going to be really hard.
Yeah, and I excluded the Ciscos and the Microsofts and the Googles from my original index because I really wanted to track the pure plays. I don't know that I'm going to have much of a choice going forward to do some of that. I may have to look at bringing some of them into the index if I want to keep the index alive because I don't know how else to replace some of these companies. Now, the second point that you brought up, Tyler, is the identity space. Thoma Bravo bought three out of the public market.
They own the identity
SailPoint,
space.
Ping, and ForgeRock. Like 3 companies go public over a period of time, and all 3 of them have been acquired by Thoma Bravo on the private equity side.
Yeah. I mean, they're going. I mean, just out in the industry in general, Thoma Bravo is going ballistic right now. Outside of cybersecurity, they went out and bought like a cloud-based ERP system for manufacturing firms, right? And then in employee productivity, I mean, you're talking to the tune of like $1 billion. They just went out and they bought a forensics firm, right? And I mean, that was $1.3 billion. They're going ham on the market, man.
What do you think their next play is then? Like they've kind of acquired the identity space, so what needs to integrate with identity?
Oh, they just spent $1.3 billion on a forensics firm. It's for defense forces, so it's for the military. So I'm wondering if they're chasing the CMMC, what's going on with CMMC and DoD, and you know what I mean? I mean, maybe that's the next phase. I don't know, but to get a military grade forensics firm, that's telling you something.
Yeah,
take on the CrowdStrikes and Mandiants of the world.
Well, I'd like to see, how they're, because I think there's synergies across the 3 identity portfolios that they have. So my first question would be, like, what are they doing with SailPoint, Ping, and ForgeRock? Does that come together as a mega identity provider, or are pieces of it going to be leveraged in other parts of the portfolio? What I think is interesting, all the private equity firms, they've got capital they have to put to work because they have to get return on investment. So they're still buying because they have to put those dollars to work. We've seen the VCs back off a little bit, but the private equity firms are still acquiring because they've got all this money that they have to get working for their clients to make money, right? And so it's just an interesting dynamic right now of who's buying.
Right. And again, I mean, the due diligence is going to be there, right? I mean, for any startup that's out there right now, just know you should be looking at margin. You should be looking at EBITDA. You should be looking at cash flow, cash on hand, making sure you have a secure financial posture for your business.
I think being able to have all of those companies and have them under one portfolio does lend itself to interesting things where you can do something like a ZTNA with a good identity provider. You're not relying on Microsoft or Okta. You've got your own OAuth. You've got a multi-factor, and you've got cybersecurity. They picked up it was Proofpoint and Barracuda. So now you've got endpoint backup and you've got email security. So they're making a play for that kind of Microsoft entire suite where they're controlling the endpoint and the identity and the security.
Yep. Yeah, you're right. Absolutely. A couple other quick highlights. So no IPOs. ZeroFox was the only one in 2022, which I mentioned. We talked about the ForgeRock, Thoma Bravo thing. Gen Digital lays off 25% of their Czechia staff. So finished the acquisition. I think that's from the Avast side of the house. I think Avast was out of Czechia because they have dual headquarters. Tempe and Prague, I believe, are their dual headquarters, laying off some stuff. IronNet, we talked about. Siren, we talked about. Those companies are definitely facing liquidity, going out of business issues. Thoma Bravo keeps buying. So, on the public market side, it's interesting. It'll be interesting. Stocks that are making money, though, are performing. And I think that's the point, right? You see the ones that are doing well still buying. So Splunk and Qualys and a few others have made some acquisitions on the private side, which we'll get into in a second. But if you're in a good cash position and good profit position, you're in a much better position to get through this turmoil. That's for sure.
Yeah, I think some of the things that we haven't been considering, though, too, is as we walk through this turmoil, especially if you're a company looking for labor and stuff, you're going to have a whole bunch of resources that are out on the market for lower cost hiring. You're going to have a lot of outsourcing companies that may be very highly skilled and work on large projects that are going to be available with time and or money. But that also lends itself to things like ransomware, where you have a lot of very desperate people that are very technical that now have to make some kind of money. So I think we're going to see that collision of both the defensive side and what's capable and what's being built, along with the offensive side of ransomware going after this and it becoming a bigger issue for everybody.
Yeah, no, that's a great point. I mean, it's the blessing and the curse, right? The blessing for folks who need good employees, good staff, good technical resources. You know, we can start having our pick, but that also lends to some of the misbehavior on the opposite side of that coin, right? So, yeah, the blessing and the curse of this happening.
Yep, for sure. On the private side, money's still flowing. Now, you're not seeing as many deals or as large of deals, because I look at the size and the quantity, but people are still raising money. There's a couple really interesting ones. So Arctic Wolf raised $401 million on a convertible note. So again, pretty interesting way to do it. Instead of going out to the VCs, potentially taking a flat or a down round, they raise money through a convertible note that gets converted into stock. That's an interesting vehicle to use. It's almost like a debt instrument, but that's how they were able to fund their next round, probably without taking much dilution in their valuation.
Okay. Yeah, I was actually going to ask, what is the strategy around doing it that way versus your traditional?
Because what you're basically doing is saying, we're going to use our existing valuation and raise money off of that instead of getting reevaluated in the open market, right? So let's say they needed 400 million and they went to the VCs, and the VCs could come back and say, yeah, the last time you were valued at this, but we're not going to value you that anymore. So now we're going to value at this. Well, that's a down round, basically, right? And so all the previous investors kind of get diluted a bit. So by going the convertible note path, what they probably did is said, this is what we raised money on our last round. If you'd like that valuation, we'll offer that same valuation to you and convert that into equity at this prearranged conversion rate, right? And I think that's what they did to raise this $401 million.
Got it.
Is that a higher risk for the investor?
Potentially, right? Because when you think about it, if Arctic Wolf should have been devalued a bit, then yes, it's a little bit of a risk because you're kind of paying a premium to get in. Right? But some people will, right? There are investors out there saying, darn, I missed the last round. I wish I were in. And if those terms were offered again, I'd take it. So I think you've got some investors who maybe couldn't have gotten in previous rounds and said, hey, this is one way for me to get in. It's potentially risky, though, because, again, depending on the exit for Arctic Wolf, if it goes down, you're actually in a loss position. So there is risk associated with this, depending on what the conversion rate was. Yeah. The SNCC raise, $196.5 million on a $7.6 billion valuation, I believe is what it was. It was basically a 37x. Now, those valuations are unheard of, guys, right now, right? What I'm hearing from people right now is most people don't know how to value a company, right? Let alone a 37x valuation. Somehow they got it, right? And there's been a lot of people that have that really like where SNCC has been going. That valuation at this time is just when I read it, I was like, oh my gosh, like nobody's getting a 37x right now.
Yeah.
That's wild.
That's insane.
Does that mean there's deals where they're almost too big to fail, or people are doubling down because they're seeing good momentum and they want to see that big return at the end? That's wild for this. Yes.
It's a crazy valuation, which means there has to be, one, it's protecting part of your base, I think, but in previous rounds, but also it has to be an exit coming up here. So this cash infusion probably gets them through the year, maybe in a position in 2024 to go public. That's when everybody gets cashed out. So again, that valuation was just crazy to me.
Makes me wonder if there were discussions before the market started to change in the valuation. So there's already an exit strategy with a couple big companies, maybe.
Could be. But again, everybody is reevaluating. So like the whole Apiro Palo Alto deal, which is the other one that's on here, right? That deal fell through because they couldn't agree on valuation. So that deal falls through. Apiro then turns around and goes out and raises $100 million from their existing kind of A-list investors because they needed the money to stay afloat. So again, if you can't agree on a valuation, the deal falls through. They had to pivot quickly and go raise enough money to stay afloat and to continue to survive. So
it just shows you the level of diligence that's happening now in these situations, right? I mean, they went to the table and they had to negotiate hard, and obviously it didn't work, right? Because Paulo was going to be tight on it. I mean, this is polar opposite of what we saw, last year, 2 years ago, when it was wild west. Buy.
Yep.
No
remember
diligence.
when we had 3 quarters in a row of the index just going through the roof? Like every quarter we were setting a record, right? Complete opposite now. A couple other highlights on the private side. So Blue Hexagon gets acquired by Qualys, but it's an asset sale. I mean, Sumedh was smart. He knew they were in trouble. He wanted the tech. He probably paid pennies on the dollar to pull in the technology, but it was an asset-only sale. Cybersecurity got a pretty good exit from Palo Alto at $200 million.
Gets them in the AppSec game, right?
Yep. Yeah, exactly right. It's probably for the Prisma portfolio, right? Elusive gets picked up by Proofpoint. So there was an exit. Remediant gets picked up by Netrix. So some good exits here for companies that we've worked with and known for years. So there are still acquisitions happening. The question is, what's the valuation on those? And then this whole thing with Cybereason, IPO fails. They're looking for a buyer. They just did a second round of layoffs. They did the big round right around RSA. They did another one in Q4. They laid off another 200 people. So Cybereason's in this really weird position of like, what's their future?
I think I almost feel like they missed the bus because I mean, if you look at like 2020-ish, you had the Carbon Blacks, the Silences, the End Games, all going full bore, and Cybereason's go to market was just kludgy, right? It just wasn't cohesive. It just they missed the bus. I think they just waited too long.
I think so too, because if you look at the last endpoint exit in the space, Sentinel-1, right? Yeah. And the valuation of that, they should have gone like right after Sentinel-1. Cybereason needed to be there like right after the Sentinel-1. The timing would have been perfect. They would have got a, kind of a double endpoint pop before the market imploded, right? But nope, they missed it. And now they're just laying people off, cutting stuff back, looking for a buyer. It's not looking pretty. Nope. Not looking pretty. Those are the highlights. Tyler, Jason, any additional thoughts on that segment? It's definitely a consolidation, fire sale kind of market.
It's going to be an interesting 2023. I'll put it that way. Every once in a while, we should do a check-in, even before our next, security money session. We should do some little check-ins if any major news comes out.
Yeah, we should. Yeah, the Siren news was almost right on top of the IronNet news, and I almost missed it because I wasn't thinking. I wasn't looking for it, and then somebody dropped it in the chat this morning. I was like, "Oh my gosh, that's 2 public companies about ready to go under. Like that's big news. Got to cover it."
Yep. Very, very crazy. It's hard to imagine what or predict what the next few months are going to look like. I mean, we expected some layoffs. We expected some tightening of the belts. We expected some zero budgets. And I think the good companies are doing that. I think there's a lot of the companies that have been in positions where cash burn has been out of control, staffing has been out of control, spend has been out of control. This is a good correction for the market. It still hurts, obviously.
Oh, yeah. It hurts. All right. With that, we're going to take a quick break and then cover the leadership and communications articles for this week.